All right. Hello, everybody. Good afternoon, and welcome to our annual 2016 a year in review and 2017 forecast. So every year at the end, we go in and set up some opportunities to trade for the upcoming year. We've always done a really good job on the report card. We grade ourselves during this webinar as well. But our forecast for last year ended up pretty much materializing down to the T. Of course, making a forecast is useless unless you're able to trade it accurately. And traders put a lot of weight on forecasting, a lot of weight on trying to find out what's going to happen next. But more important is what's happening now. What is price action telling you? And what could that mean for any trade ideas that you have? Especially if you're trying to make money day trading, you don't really care for too far out of a forecast. So this webinar is an attempt to give you an outlook of what could happen in 2017, but it's not to be a definitive guide that you should invest with and to put your money behind, all inclusively just thinking, hey, this is what's going to happen. Forecasting 1 year ahead of time is way too hard in today's markets. In today's electronic and digital age, too much could happen. Too much could go wrong to throw a wrench in the gears. In fact, when we look at our 2016 recap, you'll sit here and scratch your head and say, wow, did that all really happen in 2016? Okay, so a lot can go wrong, a lot can go right. This is just a forecast. The way you trade is more important than actually knowing where things are going to go. Where things are going to go don't matter unless you have a strategy to get there with them and make some money. Okay, I want to remind you this information in this presentation is for educational purposes. It's not to be taken as literal investment advice. The risk of trading in security markets can be substantial. You should consider if engaging in such activities suitable to your own financial situation. Trade Pro Academy is not responsible for any liabilities arising as a result of your market involvement or individual trade activities. All right, we got a lot of good info for you. So let's get started. First of all, we want to take this opportunity to review 2016. And what we want to talk about here is what happened in this crazy 2016 year in the markets and what it means for us going forward. Okay, we started out January of 2016 on the S&P 500. So let's go in here. We already have the S&P 500 in January on a daily chart. We started the year with a dud. All right, the Federal Reserve raised rates. That led to the market rallying a little bit into December right here. And then as soon as the new year started, in fact, around December 30th, we closed towards a high, and the selling pressure just started and continued all throughout January. In fact, it was the worst start in equity markets history in any given year of all time. All right, we dropped 11.98%, almost 12% drop in this structure here in 19 days of time, 19 calendar days, less than that in market days. All right, what was kind of the impact? What caused some of the selling? It was Chinese trouble. All right, there was a lot of debt issues out there in China towards January. It spooked the markets. They also did a pretty big currency devaluation, and as they devalue currency, right, it puts economic pressure on the global economy. And what happened to the U.S.? They took a hit as a result. So January started slow. It started not slow. It started bearish. All right, there was a lot of heavy selling, and as prices dropped, volume was building out. Asian markets led that. The contagion in the United States was a direct result of China having a little sneeze on the other side of the world, and we caught the cold. We got the bug, and prices sold down. All right, while moving into February, markets tended to bottom out and reverse around these 1820s. If you zoom out, this was a level that we were watching for very carefully. 1797 was our downside target. In fact, I still have that on the chart from there. And 1883 on the way down was our initial target to start the year. Well, we got there. We slowed down. We broke below. We left the tail in the market. We dropped down again, but just barely took out that low, and then it rallied upwards. That's very, very typical of what a market does towards a bottom. There's a last run on these lows to sucker in some more people short, to get everyone short, to get some of the buyers from here shaken out and completely squeeze out of their long positions. And when we get the buyers out and we have enough shorts, that gives us fuel to continue the rally upwards. 2016 started weak. If I would have showed you this chart at the beginning of 2016, you would have been really scared. You would have said, holy crud, this is huge. This is going to be a bad year. There's a saying out there, or it's not saying, it's more seasonality. The way January does, or the way it goes for the first month, is the way the entire year will go. Well, 2016 said, nuh-uh, not this year. You're wrong. So be careful with these sayings that traders and more importantly, these longer term guys say whatever happens in January will dictate the entire year. That's just way too simple to be true. Maybe in the 90s when you traded, that might have been something to watch for. 2016, 2017, with this digital age, with this algorithmic trading, these kind of simple statements don't really hold. That's what's frustrating a lot of investors. They're looking for simplicity. All right, they're looking for the Warren Buffett approach. They're saying if you don't understand the business, don't invest in it. They're looking for things to be too simple. I'm going to tell you something. 2016 was the year that was not simple at all. 2016 was a tough year for the professionals to make money trading because in here, they were selling into this rally. When they finally rolled over to buy it, it sold off. It was a tough fight. Okay, we're going to look at some more stuff as to why the year was challenging. But all in all, we had a positive year. We're up about 10% on the year so far. Okay, it's been a good run. In fact, it took a while to get back to this level, but then we never looked back and continued higher and higher. All right, it's been a challenging year. In mid-February to about June 23rd, so now we're starting to look a little bit from this bottom to about here. We had a nice rally. This was on the back of a ton of shorts being squeezed out. A lot of big money got rid of their positions. And a lot of questions that came out to me that month was, well, George, if these prices are going down, are big institutions shorting? No, they're not. But what you have to understand is a lot of big institutions don't get short unless they're a hedge fund. Institutional money doesn't get short. They buy downside protection, but they don't outright short the market. So why do they go down? Well, big institutions were selling or taking profit, and that caused the sell-off. They're getting out of equity and rotating into other assets looking for safety. So that's what caused the selling. All right? And then why was the rally so strong to the upside? If everyone sold, we now have cash. And if everyone's out of their position, they have cash. As the market rallies, what is an institution concerned about? Missing out on the run. How are they going to explain to their investors they sold out here and then the market's up 10% to end the year? So they got to get back in. Institutional traders have to get back in. They have to mirror the market at the very least. So cash piles back in and starts chasing the price higher and bids it up. That's what happened mid-February to about mid-June. Through mid-April to mid-June, we started to hit a bit of a sideways period. Okay, this was a great period to be selling options. From a seasonal perspective, there's a saying, sell in May and go away. So May to about September is, in a typical year, a great opportunity to sell premium and run a neutral strategy portfolio. Okay, that's really what investing is all about. January to May, you're buying dips because you're bullish. May to September, you're running neutral strategies from a seasonality perspective. You're selling premium. September, after the usual seasonal drop that happens, and there it is, it happened again this September, not as much. We'll talk about that in a second. Then you can start buying and start running your positive portfolio or start to get bullish. All right. And then the one thing that threw a bit of fuel to that fire was on June 24th, the Brexit referendum, right? We went into the referendum here, if you guys remember, on the 23rd of June with all kinds of optimism, near a record high in the market. Okay, in fact, it pretty much was a record high. It tied the session here on June 8th. Too much optimism. This referendum was not going to happen. Impossible. Polls were showing that they were going to remain in the euro and they're not going to leave the union. It's crazy. Voters aren't that nuts, are they? And then suddenly, yes, they are that nuts. We found that out very quickly. Brexit happened, all right? The people were sick and tired of the status quo. This was a rejection of the status quo year. That's what 2016 was all about. They got sick of it. They wanted separation. They wanted to do things on their own. They wanted to control their own borders, which I don't know if it's going to be that easy, but they wanted out. And they got it, all right? We traded live on this Brexit referendum, and we did well trading it as well, all right? Well, guess what? The day after, we had a sell-off. We hit this low on the Brexit referendum. Market dropped about 6% in two sessions, here and here. This is a 6% drop, nearly, about 5.8. Actually, a little more than 6%. And then it proceeded to recover 5.8% in 5 trading days. So the momentum it lost in 2 days, it recovered in 5 days. And then we sat here for a bit of a consolidation before absolutely breaking out higher. Why did we break out so high? A lot of shorts got excited and started to short that market near the high. All right, here's a triple top pattern, said a lot of technical analysts. It's a triple top. Wait till you see what's going to happen. January was a bad month, all right? January was a terrible month. And this is a triple top pattern. And volume's starting to look a little bearish here. We're going down. And guess what? When 90% of the market thinks one thing's going to happen, it's going to go down, the opposite happens. Why? Because everybody's into one side of the trade. All right. And if everybody's already short and doesn't have any more money or margin to continue shorting, that means it takes just a little bit of upside pressure from the buyers to squeeze everybody out. And the buy stops are coming on out. And that's what you're doing. You're trading against the herd here because markets do not move because something positive is happening. It's not moving because jobs are doing great. It's not moving on economics. And if you don't understand that, you're trading back in the 2000s. Welcome to 2017. Economics are not dictating the price of the market. What's dictating the price of the market is where traders are stuck and how quickly they scramble to cover their positions. That's all it has become, right? Economics have no bearing on the market. Admit that to yourself now. Stop trying to justify things. Well, job growth is doing good. Why is the market not going up as much? It doesn't matter. All you need to know is since 2009, the Federal Reserve adopted a central banking policy to continue to create money and support the market, which dampened the downside blows and created a buy the dip at all costs. BTDAC is my abbreviation. I don't know. I just made that up. But buy the dip at all costs. Just get in there. Because what's the worst that could happen? The Federal Reserve's pumping and printing money, and they're supporting this economy. We've got low interest rates. So things are going to keep on going up. That's exactly what happened at Brexit. People bought the dip. And then we went to a consolidation or a distribution phase here for the latter part of the summer. And this showed the market resilience. All right. What ended up happening here in August and September? Chop. All right. A lot of tight wound chop. These were really hard days for long-term investors to trade and make money on. Traders love this kind of stuff. I love chop because I know where the top is. I know where the bottom is. You sell the top, buy the bottom. I actually did really well in the summer in this period here. All right. Now we look at October. The month of October tends to be the spooky month. All right. This is where traders tend to get a little scared and worried because all crashes, not all, but most crashes have started off with an October sell-off. And it looked like that was kind of the mandate here in October. It started to get gnarly and bearish on reports that what was this downside pressure? On reports that Hillary Clinton emails were uncovered by James Comey. Okay, Comey actually ended up inducing some of the sell-off, but there was a lot of long positions wound up here above these 40s that needed to get shaken out. They got shaken out. And then they say, in light of this new information, there's going to be no charges pressed and the market rallies. And all this stuff literally happens within days before an election. All right. And this brings us right up to the November election. It was political craze out there. All right. There's a lot of controversy. There's no way Trump's going to win. Polls are showing gambling websites had 92% odds of Hillary Clinton winning. 92% probability of Hillary winning. They were willing to give you 3-1. I saw 5-1 odds on some sites willing to give you to pay you if you took Trump. All right. Wow. The economy thought the status quo was coming. Trump would be a disaster for the economy. All right. Well, guess what? I told you guys on election night before this even happened. I posted. I talked about this. I ranted on YouTube. Anyone that cared to listen would have got the right idea and would have made a ton of money. All you had to do is care to listen. I said this. I said, look, I have an uneasy feeling about this election that what's expected to happen won't. I have an uneasy feeling that the status quo won't win tonight. All right? I said that in those words. Go look up LinkedIn. Go look at all the posts I did. I beat the drum saying it's not going to be that easy for Clinton to win. I think there's a lot of pissed off Americans that want more, expect more, and are not voting for Trump. I think what the message was missed here is everyone's saying what a terrible guy Trump is. Look at all the stuff he did, all this crazy things he said and did to women. Granted, yes, that's true. He may be a terrible guy. I don't know. I don't know the guy personally. I can't make statements like that. He sues everyone, so I don't want to get in his line of fire. But here's what I do know. A lot of votes were not voting for Trump. They're actually voting to end the status quo. The status quo. They're ending to drain the swamp. That's where the money was piling into. That's where the anger, the frustration over the years, being lied to, being deceived by the previous campaign, Obama's campaign, things that they had to endure. They said, enough is enough. All right, we want change. So a vote for Trump was a vote for change. Guess who promised them change? Obama did in 2008. He promised change. Trump won on the same platform, except he didn't use the word change. He used strong terminology. He campaigned to win, to gather the vote of unsatisfied voters over the years. That's what elected Trump. That's why I had a feeling, hey, you know what? This guy's going to probably win. And I knew that early in the night. And I backed that up with my mouth. I backed my mouth up with my trading account. And I started shorting into this. And we traded this live in our webinar. And we ended the webinar when we were right down here, limit down. And I said, guys, right now you're trading limit down, which means the market cannot go any further to the downside. It's easy enough for the algos to ramp this thing up at least halfway. Wow, we got a little bit more than halfway. We woke up after that crazy drop of 5% limit down, and markets were up 1.1% to finish the session. So we recovered the 5% plus added 1.1. So we went up to 6.1%. And that was the beginning of a Trump rally. So many traders and investors and everyone's confused on why the market went up if Trump is so terrible. Well, because Trump is a Republican. All right. Welcome to a presidency where your president is a Republican, the House is Republican, and the Congress is Republican. Do you think Donald Trump will have any problems passing bills the first 2 years of his presidency? Do you think so? Probably not. All right. Yeah, I know a lot of Republicans don't like him. Oh, I knew Barbara was going to say this. Sorry, Barbara. I get it. I get the point. I know that she won the popular vote. She did. All right. So the people technically did elect or should have elected Hillary Clinton as president, but the Electoral College votes and the way that it came down to it went to Trump. The Electoral College was set up that way so smaller states had a bigger voice as well. Otherwise, when the EC was formed, that was one of the big conditions of these smaller states that we now call signing the Constitution. So there might not have been a US of A without the EC. A lot of abbreviations. Who knows? All that's political stuff. I don't really care about politics. I'm Canadian. I live in Canada. I'm not allowed to have an opinion on politics because I couldn't vote. Right? If I'd cast my vote, I'd be a lot more vocal about it. I'm not. Right? So I got to shut up and talk about the market. Now, will this presidency be scary on January 20th? Who knows? We're going to talk about that in 2017. I have an opinion about this, and I'll share it with you. Okay, market recovered, and it's rallied, and it continued to rally through December. It's up 3.7% to December 13th to hit the high at 2277. All right, on December 13th, we hit an all-time high. The market was shocked. Why are we going up when we went down? Well, you know, to be perfectly honest, to me, the turning or transitional moment was when Carl Icahn left Donald Trump's ceremony or the party that they had after he won to go buy stocks. He said the market's down 5% because Donald Trump is president. He's like, that's ridiculous. So he left the Donald Trump party and went and bought futures on the open market. All right, the algos were ready to squeeze some stops. We hit limit down, so really the floor was in. You couldn't really get below that until 9:30 in the morning. We were limit down by 1 a.m. I remember trading this. All right, so we have about 8.5 hours of selling pressure just to hold it down here in order to continue lower. I didn't think that was happening. I think all these shorts would have to get squeezed at least a little bit. They'll have to get their head pinched at least a little bit. Well, they got more than their head pinched. They got completely psychoed out. I can tell you there's a ton of people that lost money continuing to short because they didn't take profit down here. I can tell you there are people listening right now that shorted here that were right in the initial momentum, had a massive amount of profit down here, started to trickle away from this, said, oh, it'll come back. It'll come back. Let me add some more. It'll come back. And a profitable trade ended up not only being a losing trade, but a devastating trade. I guarantee you a ton of accounts were blown out in this drop right here. I can also tell you a lot of traders expecting Hillary to win got ridiculously long into the election, expecting it to just rally upwards. All right, the market's going to blast higher. I said that the 2 days before the election had way too much upside for a continuation if Clinton won. I thought it was going to stay a little bit sideways, maybe trickle upwards if she won, but it was already built in. It felt like Brexit all over again, guys. I'm not going to lie about it. That's what I felt happened. Well, look at this. It recovered just as quickly. In fact, it recovered quicker. Brexit happened over about a month period. The presidency or the election achieved the same result in a day. Drop and recovery. Because there's a lot more big money at play over an event like that. That impacts the U.S. market more than Brexit did directly. All right. Also, now we finished the year. Dow's fighting to get the 20K level. It wants to touch it desperately. It ain't going to happen. All right. I think the year is pretty much done. Tomorrow's the last trading day. I got word in from multiple sources that institutions are looking to offload massive amounts of money into the end of this year. Massive. It's a little silly of them to have a massive institutional trading account, to see some slowdown here and continue to hold a position and wait for the last 2 days to offload your volume. Why? Because now the algos aren't out here as much today. All right, traders have taken a bit of a vacation and volume stinks. Volume absolutely stinks. We have 475,000 contracts and it's 12:30 for goodness sake. Yesterday we had 1 million contracts that traded, and on that 1 million we had a 20 handle drop. Okay, when you have a 20 handle drop, you're looking for 2 million SPUs at least. So we had really weak volume on the drop yesterday, and there was no chance at all for the market to catch its breath. There's a ton of sell orders waiting to hit the market. Be careful to end this year. In here, I had a feeling, a hunch. I had almost, I don't want to say hope. I wanted to see 2,300. I really did, so I could say, hey, it tagged it. I think then it was going to sell off. We didn't see it. We didn't see momentum and strength. So then I told you guys a few days ago, hey, careful, bail out of this position. Consolidation might hold. If it leaks below, sell stops are coming. Big time sell stops are coming. All right, so we're going to end the year weak, and that brings us to 2017. Really, if you look at 2016 and how it's starting, we're pretty close to looking pretty similar. Rally into it, starting a little weak. We could have a sell-off. I think that sell-off could take us down to 2,200. Let me read some quick comments, and then we'll talk about 2017. The volume for ES in a normal trading day, it depends. It really depends. I would say if you have, it also depends on the price, right? The more the price moves, the larger the volume should be. If price moves 20 handles and you got 1 million volume traded, that stinks. If you got 5 handle range or 7 handle range or 7 points in the ES and you have 1 million contracts, that's some heavy volume going through. So it's a combination of price movement through volume as well. The average is probably about 7, not 7, probably about 1. About 1 million should be where it should be at, typically on average. If it's a slow market, it could be less. But for the amount of price drop that's happening here, volume is really weak, very weak, which means selling is happening, but there's a lot of supply to sell to the end of the year from the institutions. They haven't got a lot of it off. There's still a lot more to come. And they're selling into a market that has no bids. Who the heck's going to buy this on the last day of the year? Just wait until 2017 starts. Let's get into it right now. In January 2017, there's going to be a lot of tax loss selling. If you have any positions that are losing positions, or if you want to lock in a profit, what is the number one rule of business? Defer payment as long as possible and take cash as quickly as possible. That's the name of the game. That's how a business runs. Trading is a business. There's a lot of traders waiting for January to come in and start dumping some stock to recognize that transaction so they don't have to pay tax until 2018's tax year for 2017. Delay it by a year. Hey, sell it now, pay tax in a year. If 3% inflation, you're going to pay 3% less. It's the name of the game. That's why January seasonally is a weak month. So I think in 2017, we're going to start off with some weakness in January. It's already happening. I think we're going to try to touch these 2200s. Trump's going to take office on the 20th. There's going to be some volatility there in January. And then from there, probably the next 60 to 90 days, we'll hear a lot from him on policy, and that's going to affect where we go from there. All right, I'm going to call it right now. I don't think the world's going to end because Trump's president. I think he's actually going to do okay. Not as good as he thinks he's going to, but not as terrible as everyone else that doesn't like him thinks he's going to. I think he's just going to do okay. He's got a decent platform for tax cuts, but what's going to end up happening is January is going to have Trump supporters the most angry they ever have been at him when they hear some of his policies. They understand there's tax cuts. They just don't understand that it ain't going to be for them. It's going to be for the people making $400K plus. They're going to get the deepest tax cuts. The guys making the lower tax bracket, there's only going to be 4 brackets. The bottom bracket's going to pay more tax. All right? So he promised them jobs for people who are having a hard time. They're having difficulties. They don't have as much income. And he's going to raise their taxes to pay for a tax cut for the rich. We'll see how that goes when they find out what's actually happening. I'd say probably 1% of the population knows about that. Welcome to the 1%. The fact that the tax platform does not favor the lower end of the brackets. And the higher end of the brackets are going to be paid for by an increase of the lower end of the brackets. There's more people in the lower end of the brackets than the higher end of the brackets. So collect less from more people is always a great business strategy. Yeah, great point. Let's all make more than 400K, guys. That's our goal for 2017. Let's all make more than 400K and we'll be happy. And if everyone makes more than 400K, then the tax system will be in trouble. All right, that's how 2017 is going to start in January. Expect that. I think oil prices in January, let's go to oil because we're going to do multiple assets here. I got to pick it up because we got another 15 minutes. Oil prices, we'll see 55, 56. Heck, we might even get up to as high as about 58 to 59 on oil to come into this range from May of 2015. Okay, this year oil has, in 2015, the oil got really weak. 2014, it got shellacked. 2016, it's recovered a little bit. It bottomed out in 2016 in March with the equity markets, and it's held some sideways movement. And a lot of this positive upward momentum has not happened on supply and demand. It's happened on jawboning by OPEC and non-OPEC. Guess what? They have an agreement. It's starting in January. Here's my call. We're going to start January with a lot of optimism in oil. We're going to tag the 56 to 57 level. In fact, 56.79 is where my target is on the upside for this. We might get there. Volume's weak to end the year, so don't trust this. It looks like it might be a rising wedge. So be cautious. Despite me being bullish, I'm always on the lookout for a breakout of structure, and I could change my opinion in a second. All right, that's the beautiful thing about me as a trader. I change my bias within a second or less. I don't have a bias. I trade what I see. Right now, I'm seeing momentum to the upside. There's no volume. That's why it's stalled out. In January, there's going to be excitement about oil prices. Here's my call. This OPEC, non-OPEC agreement, it's not going to happen. It's going to fall through. I give it about 2 months' time maximum. By the end of February, mark it on your calendar, they're going to scrap that agreement altogether. And I call this, Russia will not cut a single barrel in that time, not one single barrel. They're going to continue to ramp up production, right? Iran's going to ramp up production. Iraq's going to ramp up production. Everyone's going to ramp up production except Saudi Arabia until Saudi Arabia gets pissed off to the point they throw in the towel. And they're going to start ramping up production. And then RIP to oil price back in the high 40s. That's how I see it panning out. Just based on what they say, how they act, and what they actually do. You put all that together, and it ain't hard to see that oil is going to be in trouble at some point. So far, it's great. Everyone's excited, all optimistic. We got a deal on the table. Let's ask these questions. Who will participate in that deal? Who will hold their end of the bargain? Who will cheat? Who's going to audit the results? Who actually cares to cut production? All right? And more importantly, what will they benefit most from? A production cut or continued increase supply? At these high prices, I can tell you, they're saying, it's nice to go by an informal agreement that we shook hands on, but I'm going to produce more. Screw the agreement. What's going to happen? There's no repercussions. Russia has already said we are not going to cut at the beginning of January. We're going to start to introduce cuts in late January. So they've signed the deal, but they're already kind of delaying their decision. Careful. All right? Yeah, we're getting to gold. The U.S. dollar. So for 2017, today the dollar is getting crushed. It has to get crushed. At some point, it's had 1, 2, 3 higher waves. These are 3 impulsive waves. We're going to need an A, B, C type correction to come in to the dollar. So while we might start a little bit weak, I do see us finding support at 100. I shouldn't draw the retracements that deep. 100 to 101 even, to 101.50 even. This is kind of where you could start looking to get long the dollar again. I do think 2017 will be bullish the dollar. All right? Overall in 2017, I think the dollar will finish higher than 103. Doesn't mean at the beginning we can't let out some late longs here and shake out some stops. We do have to do that before we continue higher. But I think this bullish trend is going to continue on a weekly basis after we consolidate a little bit. All right, upwards move, consolidation, upwards move. That's what I expect to see. Okay, a strong U.S. dollar, however, that puts a lot of pressure on manufacturing and exports. Excuse me, guys, on manufacturing and exports. That puts a lot of pressure on that on the U.S. All right, Donald Trump has said he's going to put a 10% tariff on imports from China. He always says one figure and negotiates or bargains down. So let's call it a 5% tariff on imports from China. Okay, a stronger dollar means that we could import more goods from China. So the U.S. consumer gets a little more wealthy. Well, guess what China is going to do? They're going to devalue their currency. All right, drop the price of their currency to counteract, and that's going to cause downside pressure on the market. All right, so watch out for that. Just careful, because I think a strong U.S. dollar in the long term is actually something the Fed does not want. The Fed wants a weaker dollar because a strong dollar also pressures the Fed to raise rates. I think this year we might actually get 4 hikes. I know it sounds crazy, but a stronger dollar presses assets higher and increases pressure for interest rate hikes. Because if you don't do it when the dollar is strong, when else are you going to hike them, right? This bullish pressure on the U.S. dollar will put downside pressure on risk assets, equities, etc. So I think that's where we see the opportunity for 2017. Okay. I do not think the dollar and equity markets will travel together at the same time for long. It can't. Not that it can't, it just hasn't happened. All right. What does a strong U.S. dollar and higher interest rates mean? It means consumers are going to get pinched. Let's just call it like it is. There's a lot of debt out there. All right. Debt by the consumer, but more importantly, and on a bigger scale, debt by the government. Why do you think the Fed doesn't want to raise rates? What are they holding back? Do you think they're protecting the consumer? I'll give you a quick no on that. They're protecting the government. Think about having $14 trillion of debt and having to make debt payments. A 0.25 increase means a ton more money of cash outflows that you have to pay as a nation. Where are you going to get that money from? You could get it from tax, but Donald Trump's cutting tax, or you could issue bonds, sovereign bonds to outside investors. And you got to get foreign buyers to be buying all this stuff. If the economy is not doing good, they're not spending money on those bonds. All right, there's a lot of loss of interest in U.S. bills. We had a good auction this week, which is actually a really good auction from foreign buyers. They're back, but that's only because the market and the dollar's done so well. The first sign of this catering in, it's over. If you got higher interest rates on dropping asset prices, watch out. There's trouble for the government and for the consumer. Let me give you some more stats on the consumer. Housing prices are probably going to stall in 2017. It's had record runs. We recovered a lot of the 2009 crash. Markets like Toronto, Vancouver's already let off a little bit, but Chinese money looking for refuge and safety is going to go to Toronto. All right, Toronto's going to get beefed up, my hometown. Asset prices are going to continue to soar a little bit more until they taper off. Okay, but overall housing prices, I think, are going to stall out. They're going to fizzle out because higher borrowing costs means less consumer ability to purchase and hold these mortgages. Some defaults are going to start to appear because higher interest rates means that people who didn't budget enough space for themselves to pay a mortgage with an increase of 0.25%, you'd be surprised. Man, they're getting aggressive in giving out loans. When a bank, all this stuff's interconnected, guys. When a bank earns little interest, that means what do they have to do? They have to give out money a little more freely. They have to loosen up their criteria for giving out money. Loosen up their criteria. They get some crappy loans on the book. They get some crappy loans on the book. When interest rates go up, those loans default. If a few of them default, great. That's a cost of doing business. If a lot of them default, that's a structural problem. And I think we've gotten ourselves into that again. Look at auto loans in the U.S. Geez, if we get 4 rate hikes, mark it down right now. I'm going to call it. We're going to get an auto loan bubble to just absolutely burst. All right? People driving 4,000 Hondas that have been repackaged and loaned out multiple times. And lease companies made 20 grand off a $4,000 Honda in a year. Tell me how that makes sense. All right? You got to be careful. Credit, has been free flowing since 2009. I think 2017 we'll start to see credit start to get scaled back and harder to achieve because borrowing costs are going to increase. So be careful on that. All right, all this talk of higher interest rates, higher borrowing costs, that's going to put some downside pressure on bonds. I hate to beat up on bonds. I really do. Because, I mean, they've already been beaten up a lot in 2016. There was the great rally. There was the drop. When the market goes down, the equity markets drop, and the dollar drops January to February, I suspect bonds will go up. All right? But when we actually roll over for the remainder of the year and start getting bullish again, try to make that recovery, the dollar starts to get stronger, you can expect bonds to continue this downside sell-off. I know that this is a massive sell-off, but you could see this bond rally from 2001. This is the 30-year T-bond future. It's been going up and up. All right, it's time. I think we can continue to go down. Okay, let's look at gold. Sorry, you guys. Let's look at gold. Here's the price of gold. All right, it's got clobbered. I think we're starting to see a bit of a turnaround, but I would not be buying gold yet. All right, not quite yet. If you bought it already, good. You got in early. In retrospect, it was a good trade, but it could have continued lower. So just be cautious. 76.4% retracement of this upside swing happened to be right at where it paused. So that's a nice bounce, but careful because there could be some more selling to come into here. It all depends on what happens in January. Okay, markets start to go down, expect gold to rally along with bonds. But if we continue to see upside, if this dip gets bought in the S&P 500 on the short term, if this thing comes down and just pick it back up through January, gold's going to continue to get crushed. So we're at a turning point here. All right, we need to let off some buyers. We clawed or climbed too far too fast. So the beginning of the year, we're going to start a little weak, but that doesn't mean that that's your whole 2017 trading plan. All right, I think 2017 is going to be the year of difficulty. I don't think 2017 will have as many gains in the equities. I think it'll be more choppy. It'll be more difficult to trade. All right, interest rates increasing are going to put pressure on all risk assets. All right, the U.S. dollar is going to rally. It's going to put downside pressure on oil. So it's going to be a challenging year, I'll tell you that much. It will not be easy. If you thought 2016 was hard, wait till you see 2017. All right, I also got a feeling that we're going to see some kind of flash crash type event in 2017. How am I predicting that? I'm not just making it up. I've done some stats on it. And on years like 2017, on what's expected to happen in 2017, that's when these flash crashes happen, all right? Flash crashes tend to happen when there's a lot of volatility, all right? Volatility that moves up and down with uncertainty, and a lot of traders who have cash, who got positions, HFTs, algos, all go in and start trading in one pool at the same time because algorithms aren't coded for that kind of stuff. They just blow up. They go nuts. All right, and I don't feel sorry for them at all. I'd say in 2017, we're going to have a spooky type of black swan flash crash at some point. I got a just weird feeling. This wasn't supposed to make my official 2017 forecast, but I got this weird feeling about me. We're going to see some weird electronic stuff go through. Protect yourself. I would say in 2017, let me finish it off by saying this. As an investor, 2016 was very volatile for you. Take the lessons that you've learned into 2017 and protect yourself. Stop trading like an amateur. Start trading like a professional. If you're going to invest for the long term, and I know some of you on YouTube are here as well, or probably more investors, swing traders, doesn't mean you shouldn't be long. Get long, but make sure you have put side protection. Get long the ES, buy a put spread. If you're coming up, roll that put spread higher, roll it out. Protect your profits. I can tell you there isn't one single institution out there that doesn't attempt to protect the downside at the expense of limiting their upside gains. Okay? What I mean is if this happens, if that was 100% in the move, there's nothing wrong of you making 90% of that move profit and spending the 10% for insurance on the way out. Because the point of insurance is if you crash, you're going to get paid out. All right? That's the point of insurance. You're not looking to crash. You don't go in your car every day saying, which tree am I going to wrap my car around today? Because that's not your intent. But if it does happen, you need to have some kind of protection. All right? So 2017, I'll wrap it up and end it off by saying this. It's going to be a volatile year. We're finishing 2016 at a record high after some freaky events. All in 1 year, we've had the worst start to 1 year in January with a massive sell-off, a massive economic country leaving a union and that recovering, okay? We've had a presidency that shocked the world, a lot of political unrest, right? A lot of protests. We had a lot of terrorism events. 2016, all in all, was a pretty crappy year for a lot of people. Not for the market. The market's trading at all-time high. So what I'm saying is, if all these crappy events couldn't bring us down and keep us down, there's two scenarios. We continue to rally, and we still keep kicking the can down the road in 2017, keep pumping more stimulus. We'll see what Europe does, see what Japan does. Keep pumping more stimulus, keep this thing rolling higher as the actual core under the hood begins to, or continues to rot, really. It's not a great economic landscape. Or we're going to start to get some good news, and that's going to cause a crash. If bad news couldn't get us to go down, good news might. So be very careful. 2017, expect the unexpected. Wipe the slate clean. Whatever you've done in 2016, close that out and say it's been a good year. I'm moving on. 2017, start fresh. Have a strategy. Have a plan. And I'm going to challenge all of you listening today to do one thing, and that's to ditch your bias. Forget about your stupid bias. Your bias means nothing. You're not trading. You're not investing to be right, are you? You go to vacation and say, hey, I did great trading this last year. I was right 95% of the time. You go to the bar and say, hey, I'll have 2 mojitos, and I'd like to pay with it from my 95% right currency. I was right 95% of the time, so give me 2 mojitos. No, you're doing it to make money. Having a bias is going to consistently lose you money. All right? It's ironic that I spent this entire webinar talking about a forecast and what happened in 2016, but I'm going to tell you, have no opinion, have no bias, have no predetermined direction. Look at price, look at volume, look at order flow. Look at the things we teach you in Trade Pro Academy. Look at a trading filter, look at market profiles, follow and closely follow correlations. All right? Look at pivot points. Look at where market delta is going. Look at point and figure reversal charts. Look at the things that will make you profitable. All right, because that's what you need to do in 2017. It'll be challenging, but I wish you guys good luck. If you want to join Trade Pro Academy, you should. The service is $79 a month, and you get everything included. All of our courses, live webinars every Sunday, live midday updates at 12 p.m. noon, and the futures course in its entirety, plus some live trading of important events like Brexit and election. All right, I wish you guys a great holiday. Happy New Year. 2017 will be trying times. It'll be exciting. There will be volatility, and I couldn't be more excited to ring in the new year. So I hope you guys have an awesome celebration. Be safe with your families and friends out there. No problem. Did you guys enjoy it? You pumped to start 2017? I'm pumped. All right. I can tell you guys this. I don't know where the market's going to go. This is just a forecast, an idea. But I will tell you this much, no matter where it goes, myself and the Trade Pro subscribers included, we're going to make money. No matter where it goes. It'll tell us where it's going, and it'll leave enough meat on the bone for us to profit. That's the exciting part about this market. Take care, guys. Have a wonderful afternoon. If you have any questions, email me, info@Trade Pro Academy or Georgia Trade Pro Academy. Hope you've enjoyed this webinar. I'll see you next Tuesday. Tuesday coming up for a midday update. Market Analysis Live. This Sunday is canceled, so we did this in lieu of it because it's New Year's. All right? Happy New Year's. Happy 2017. Please be safe. Enjoy it with your family. Don't do anything crazy, and I'll see you next year for some great analysis and tips and tricks. All right? Stay green. Absolutely. Thanks, Barbara. Happy New Year, guys. All the best. I'll post this on the website shortly. Goodbye.